Again. But it does take us back to our question of the day. The bigger theme here is that US tech, once again, is powering ahead, delivering fresh records. Take a look at what is happening in the S&P 500 as well today. Does it make sense? Is this logical? Why is tech at a record? We've been trying to get an answer to that question throughout the day. Got another stab at that now. Bilal Hafeez, Macro Hive CEO and founder, joining us for our final show. Great to see you.
Likewise, great to see you too.
Can you answer that question? Why is tech at a record? Does it make sense?
Well, I think is AI. I think AI is the biggest story right now, and I think there's a huge amount of investment in this across every single sector, not just tech. So everybody's piling into this. There's a shortage of the types of chips that you need that's buoying all of the chip makers. So I think that's simply the biggest story. Does it make sense? When you look at valuations, things look stretched. But then when we look historically, whenever there's a new technological breakthrough, everything goes much further than you think. So from a historical perspective, it kind of makes sense. Yeah. But in the end, we know that only a few companies will end up being truly profitable and be able to deliver on those valuations.
So, Bilal, is there something to be said for that big tech is still being looked at as a safety trade right now?
Yes, I do think so. You know, when I was speaking to, over the course of this week, a number of clients, the big thing they emphasized was that they want to invest in companies that have good balance sheets, so quality names, you know, have good income streams, and have some kind of AI exposure. And then big tech basically ticks all of those boxes. So unlike, say, the dot-com period where they were all loss-making, these tech companies, you know, in this case, the characteristics of big tech are perfect for this environment.
Are US equities rallying because the Fed's not going to be cutting as much and the economy looks good, or should it be the opposite? What I'm really struggling with at the beginning of this year is equity markets just seem to rally regardless. Yeah. The idea was that the Fed was going to be cutting. That was great for equities. Now the Fed's not cutting. Maybe the US economy looks strong. That's good for equities, and tech is doing well. Can you have it both ways?
Yeah, I mean, I think obviously it kind of partly depends on the reason why the Fed is going to cut. So, at the moment, the reason is inflation's falling. It's not because growth is falling. So in some ways, what's happening now is that the Fed's got this perfect scenario where inflation's falling, they can afford to cut rates, and that's going to stimulate growth. Now, the period last year where the market got worried about the Fed and when term premium rose over the summer of last year, that's when stocks tumbled. So, we aren't in that situation. So in the absence of that, the picture overall looks really quite good for tech. And of course, we have to remember that low yields work really well for tech stocks, which are viewed as these long duration assets.
Okay, so that also brings us to the question, though, how many cuts are we going to see? So clearly the market's repricing a bit, but we're still looking at 50% possibility of a cut in March. You guys are actually pretty aggressive on that. You see 50 basis points of a cut in March?
Yeah. I mean, this is one of the big changes in our view. Our star economist, Dominique Dworfrager, who called the Fed hiking cycle super well over the last few years, she's had a massive pivot in her view. And her argument is that because inflation's fallen so much, the Fed can afford to be very aggressive. And on top of that, because of the US election, the Fed would not want to act too much in the second half of this year. So essentially, they're going to try to force all of their cuts into the first half of this year. And so our view in the end is that we think there's a very good chance they do 50 in March. So not even just 25, but a 50 basis point cut and start with a bang.
If they don't deliver that, the longer they leave it, the more problems they're going to have then. The signals coming out over the last few days has been, actually, we want to backload it towards the end of this year. That's certainly also the message from the ECB. Can the Fed cut rates in the second half of this year, given the political backdrop that Dominique's talking about?
Yeah, I struggle to see how they can start to cut near the election. I mean, I think they'll just want to stay away from the election sort of cycle as much as possible, especially...
So if they haven't cut by the end of the spring, they're not going to cut at all?
I think they'll find it much harder to cut, unless the economy's falling off the cliff at that point. Because the other risk they have is that a lot of the downtrend in inflation is occurring right now. And as we go into the summer and later in this year, inflation may start to rise back up again because of wage pressures and all those sorts of things. So the longer they leave it, the harder it will be for them to cut.
To that point, what are the chances that inflation picks up again because of the elections? That kind of no matter who is in the White House, there's going to be more spending on different stuff, and that's going to reaccelerate growth and inflation?
Yeah, I think that's absolutely the biggest risk that will occur. Once whoever gets into power, they will stimulate the economy in some form or another. And on top of the economy is almost at full employment as well. And one of the things that has helped keep inflation low over the past year or two has been the number of foreign workers that have immigrated into the US. And we know that immigration is a big political issue right now. So even the Democrats may try to scale that back, was Biden to be re-elected, and Trump for sure would. So you wouldn't get that positive labor supply shock in addition to a potential stimulus as well. So all of these forces will be very inflationary.
What about here in Europe? Today we saw a significant drop in UK retail sales. I have to say, we did all of our Christmas shopping in October and November. I kind of caution some of the my wife. Yeah, never going to be me. Not going near a shop. But the broad data still points to this idea that growth is okay, the labour market is still relatively all right, things are slowing, but the Bank of England certainly is indicating that it wants to wait and be very clear that we do have this trend firmly cemented in. The ECB this week has made it very clear as well. Do you think the ECB, the Bank of England, are also going to be cutting in the back half of this year? How late can they leave it?
Yeah, it's a great question. I think ECB certainly will probably try to cut later on in the year, probably June is our base case. And that's partly just because of the way wages are determined in Europe. It just takes a bit longer.
Yep.
So they'll wait.
Some of the wage stories at the moment coming out of Germany are eye-watering still.
Absolutely, yeah, exactly. So I think that, and it's more unionised and all of those sorts of things. So I think that is a good case for the ECB. I think the Bank of England, will be a bit more dovish. I think there's a good chance they cut sooner rather than later. The challenge in the UK at the moment is the quality of the labour market data is terrible. Yeah. Like, nobody knows what's going on in the labour market. So it's really hard to extract any information from the labour market. But certainly the trend in inflation is lower in the UK. And obviously retail sales today was very weak. And then we also know lots of remortgaging, in housing, that's all going to feed through. Rents are high. That's taking a lot of income away from people. So I think that whole kind of picture sort of tells us something about the state of the consumer.
But we had higher than expected inflation data.
Yes, we did, but I think that's more of an anomaly. That's more of a one-off than anything else.
So, Bilal, we'll wrap this all up for me. What is your biggest sort of, what trade are you most excited about right now that this is the backdrop that you're looking at?
Yeah, so the three things I'm really focused on right now. On the FX side, I think the dollar is going to do quite well in the next few months. So I think the dollar had a sort of a beating, you could say, in Q4, and I think it will do very well in the next few months or so. On the equity side, I think Japanese stocks will continue to do well, partly because the currency is very weak. I think also partly because the earnings in Japan are relatively strong and valuations look relatively attractive on a global basis. Then on the interest rate side, my main kind of view there is curve steepening, so 2s, 10s steepening. So I think that there's not enough term premia in the longer end of the rates curve. So three views: bullish dollar, bullish Japanese stocks, and steeper yield.
But that's the wrong kind of steepening, isn't it? That's front-end rates maybe staying where they are for longer, and the back end, that's the unhappy steepening, as some people are now calling it.
Yeah, absolutely. And I think that's the big risk for this year, that you get this unhappy steepening. And so for me, that's like a structural trade you get for this year, which is why I'd be neutral on US stocks right now.
Right.
I just laugh because unhappy steepening is like that's a great moment.
Yeah, I'll have to use that in our research.
I've definitely taken this from somebody else. I read this first thing this morning somewhere in one of the pieces of research that I read this morning. It's basically the wrong kind of curve steepening. Yeah. You'd be certainly hoping for front-end rates to come down. In terms of which is the biggest threat, markets or politics this year? For sort of Fed or central banks or politics?
Yeah, that's a good question. I think that, Fed will always be a super important driver for everything, but I think this could be the year where politics could really become a big driver. And one of the reasons I say that is, obviously, we have Trump in the equation, and that's a real wild card. And there's a real case here where Trump could go after the Fed, was he to be elected, and just say, look, we're changing the whole governance structure of the Fed. And that, when you do that, and if you look at emerging markets when they do that, that's really quite a big deal in the country.
You might see some term premium reaction.
Exactly. Yeah, and then obviously we have a ton of elections around the world this year as well.
Bilal, I'm sure, owns an alarm clock. I'm sure he will be waking up early to join me on the new morning show. And if you're in New York, I'm sure Alex will be delighted to host you.
Absolutely.
In the afternoons. The US market closed. Bilal Hafeez, Macro Hive, thank you very much indeed. OK.